Today we're going to cover Chapter 34. It's titled The 4,913 Days, approximately 13 and a half years of nothing. We're going to do an in-depth analysis of the Standard & Poor's 500 Index between 1999 and 2013. That's 15 years. That's 5,478 days. So it's a long time period. If you've been retired, you were retired during some or all of this time period. So it's important to know we looked at actually what happened. No one can refute this data. It's actual factual data and is brought to you either through data from Yahoo Finance or onestock.com. So we want to make sure you understand exactly what happens during this time period. Everyone will tell you, if you invest in the stock market, you're going to have to go through some volatility. You're going to have some losses at some point, but you do this over the long haul. No matter what, you make money, and no matter what, they always say the market goes up. Well, over the long run, the market has always gone up. Does that mean it will always go up in the future? No. Do I think it will? Yes. It just depends on what time period you're looking at. They also say that if you invest for the long term, you should get a really good rate of return because the risk you're taking should be equal to the return you get. Well, if you look at the time period between 1999 through 2013, the stock market did go up. It had a lot of volatility, as you see by the graph, but it did go up over time, and it looks like it went up substantially. But as you look at the numbers, the S&P 500 Index 500 only went up by an average compounded increase of 2.75% per year for that 15-year time period. Think about all the risk you took. In 2000, 2001, 2002, you could have lost over 50%. In 2008, you could have lost 40%. And yet you did all that, you took all that risk just to get a 2.75% annual compounded return, and that's without fees. If you paid an average fee of 3%, it means you lost money during that time period, which we saw a lot of clients do. So you have to understand those numbers. Over 15 years, it's a fact that the S&P 500 Index from 1999 through 2013 only increased by 2.75% per year during that entire time period. So not very much return for a tremendous amount of risk. What's even more amazing, more startling, is that there was a time period. Remember, I told you there was 5,478 days in this 15-year time period. There was a 4,913-day time period, consecutive time period, 13 and a half years, when the S&P 500 Index went up by zero. Between July 16th, 1999, when the S&P 500 Index was 1,418, in December 27, 2012, the S&P 500 Index was 1,418, which means during that entire 13 and a half year time period, it went up by zero. So 4,913 days out of 5,478 days, the S&P 500 Index went up zero during that 15-year time period. So the only time you would have made money would have been right at the beginning of that 15-year time period and right at the end of that 15-year time period if you stayed in it for the full 15 years. And if you stayed in it for the full 15 years, you were rewarded with a whopping 2.75% annual increase for the volatility you withstood and for the amount of time you locked your money into the stock market. So you want to make sure you know what's happening before you make those types of decisions. We think volatility reduction is paramount in developing what we call a successful long-term retirement income plan, because if you have volatility, you can't create constant income, and it's impossible to guarantee your money will never run out for as long as you live. And as you read through this chapter, you'll find it, I think, very interesting when you get to the section that talks about the different rates of return that the S&P 500 Index earned from 1999 through 2013 on an annual basis. There were only 4 years where the S&P 500 Index decreased, and there were 11 years where it either stayed the same or increased. The problem was those 4 years had decreases so significant that it tainted the rest of the increases the entire time, where for 15 years the S&P 500 Index only averaged a 2.75% increase without taking fees into consideration. So again, some great information. If you look at an example in this chapter, it shows $100,000 going into an investment, and if somehow you're able to earn the same rates of return that the S&P 500 Index earned, because remember, you can't invest directly in the S&P 500 Index, but if you got those same returns, $100,000 would have grown to $150,352 after 15 years, and that's without taking fees into consideration. That's a 2.75% annual increase. If you took a 3% fee into consideration, you would have lost money during that 15-year time period. So a very long time period. If you were retired during that whole time period, can you imagine losing money over 15 years? That would be traumatic. Same thing happens when you look at trying to take income out of a portfolio during this time period. Let's assume you have that same $100,000 portfolio, and let's assume you were able to obtain the same rates of return as the S&P 500 index, even though you can't invest directly in the index. And let's assume you took out $6,000 of income per year. That means either you taking $6,000 out and you had no fees, which you probably couldn't do, or you taking $4,000 out and you paid $2,000 in fees. At the end of 15 years in 2013, your portfolio value would have ended at $15,129. So it's important to note, you started with $100,000 and you ended with $15,000 at the end of that time period, which means your money wasn't going to last that much longer based on those rates of returns that we achieved. So tremendously important for you to understand the concepts associated with volatility, time periods, and when someone says invest for the long haul, we believe 15 years is a long haul, especially in retirement. 15 years might be all of your retirement. 15 years might be 60% of your retirement. Or if you're lucky, 15 years would be half of your retirement. But that's still a very long time period. So we think by understanding the concepts between these sheets in this chapter, the 4,913 Days of Nothing, you'll start to understand the risk that you take by investing in the stock market.